You're doing 300,000 in revenue. You've got a team of 4 and your clients are happy. By all accounts, your business looks very successful from the outside. However, you yourself are taking home 45,000, which is less than you made in your corporate job, and you're working 3 times as hard. It's at this point that you realize there is a massive difference between building a 6-figure business and paying yourself 6 figures. And understanding the gap between those two things is critical if you want to start paying yourself more. In this video, I'm going to show you the detailed maths behind what your business needs to look like to pay you at least 100,000 per year, and the 3 main culprits that are probably stopping you from doing that right now. Hi, I'm Thea. I'm a CFO and founder and the creator of Calm, which helps businesses scale from exhausting 20K months to enjoyable 50, 60, 100K ones. In my day-to-day work, here's what I see constantly. Founders building to multiple 6 figures in revenue and assuming they'll finally be able to pay themselves a great salary. But when they look at what's actually left after covering costs, the number is shockingly low. I've worked with founders doing 300, 400, even 500,000 in revenue who are still paying themselves 40 or 50,000 because the structure underneath isn't built to support a 6-figure salary. And most people don't realize that until they're already stuck in it. So today I'm going to walk you through the actual numbers, what profit you really need, what revenue that requires, and why the maths probably isn't working for you right now. Before we get into the numbers, I need to say something really important. When we talk about paying yourself 6 figures, I'm talking about cash that you're extracting from the business. However, as a director of the company, that's not necessarily the most tax efficient way to extract value from your business. There are other ways to extract value that can be far more beneficial from a tax perspective. Things like paying into a pension or an ISA, or making sure you're putting the right expenses through the business. How you do this for your specific situation needs to be planned with a tax accountant who understands your circumstances. I am not a tax accountant. The point of this video is not to give you tax advice or to give you the precise number you should aim for. The point is to illustrate the difference between building a 6-figure business and building a business that can give you 6 figures in actual cash take home, because those two things are very different. I'm going to show you what impacts that number, what your business might need to look like in terms of size and structure to support it, and the different layers inside your P&L that influence whether you can actually pay yourself what you want. That base understanding is what most founders are missing. So the numbers we're going to walk through are based on the assumption that you know what you need to extract in cash terms. We're not accounting for pensions or ISAs or other tax planning strategies. We're just looking at if you need X amount in cash in your personal account after tax, what does your business need to look like? Once you understand that structure, you can then work with your accountant to optimize it for your situation. For simplicity, in this video, I'm going to use UK tax structures and rates. But if you're based elsewhere, just swap in your applicable tax info and the principles stay the same. Okay, before we dive into the detailed maths, let me show you the big picture of what needs to happen. Your business generates revenue, and from that revenue, you pay your people costs and your operating expenses. What's left is your profit. Then from that profit, you need to pay tax. After tax, you need to keep some money in the business as a buffer and some for reinvestment. And what's left after all of that can go towards paying yourself. It's simple in theory, but here's where it gets complicated. When you pay yourself, you're not just moving money from the business account to your personal account. You're paying yourself through a combination of salary, i.e. payroll, and dividends or owner's draw. And each of those has its own tax treatment. Here in the UK, salary comes with income tax and national insurance, and your dividends come with dividend tax, which has different rates depending on how much income you have. So by the time you account for tax on the business profits, the retention you need to keep in the business, the salary tax, the dividend tax at multiple rates, working out what you actually need becomes genuinely complex. That's why most founders are shocked when they realize how much revenue they need to be bringing in at the top in order to pay themselves 6 figures. So here's what we're going to do today. I'm going to walk you through this in 2 clear steps. In step 1, we'll work out how much gross income you personally need, so that once all of the personal taxes are taken into account, you end up with 100,000 in your personal bank account. This will be the gross amount you need to be able to extract from the bottom line of the business. In step 2, we'll then calculate what your P&L needs to look like in order to generate that gross amount at the bottom. Now, there's going to be a lot of numbers flying around here, so to make it easier for you, I've created a simple calculator that will do the heavy lifting for you. You can download it below and plug your numbers in as we go. Pause me here, go and grab that, and let's get into it. The first step is to work out how much you need to extract from the business in order to end up with 100,000 in your pocket after tax. When you're a director of a limited company, you can pay yourself through salary or through dividends or a combination of both. You get a personal allowance of £12,570. That's tax-free income. You also get a dividend allowance of £500. So your first £13,000 is completely tax-free. In this example, because of the amount we're aiming to withdraw, we're not taking any salary, just dividends. You can adjust this in the calculator based on your own situation and what your accountant recommends. Okay, so dividends get taxed across 3 different bands depending on your total income. As I said, the first 500 of dividends each year is your dividend allowance. There's no tax on that. After that, there's a basic rate, and then there are 2 higher rate bands. Again, if any of the rates I'm talking about have changed since I filmed this, you can update them in the calculator. So let's walk through what this means for our 100k target. So your first 13,000 is tax-free. Next, there's just over 37,000 in the basic rate band. Tax on that is 8.75%. So that's £3,255, leaving you with £33,945 net. So now you've got just over 47,000 in your pocket. So you still need another 53,000 to reach that 100k mark. From here, every pound of dividend you take gets taxed at least 33.75%. Which means to figure out how much gross dividend you need, you divide that remaining net target by 0.6625. When we do that, to get 53,000 net at this rate, we need roughly 80k in gross. But just as a side note here, because the total income is ending up at over 125,000, it means a small portion of that is going to fall into that additional higher band rate at 39.35. That's a tiny little bit extra tax, but the calculator is going to add this all up for you. Our total gross income now is that 12,500 personal allowance, 500 from the dividend allowance, then 37,200 from the basic rate portion. That is your personal allowance and your dividend allowance covered, and a little over 80,000 in those higher band rates. So in total now, our gross income is at £130,719, and our tax paid on that is going to be 30,719, meaning that net in your pocket is 100,000. So the key takeaway from step 1 is this: to take home 100,000 after all the personal taxes, you need to extract roughly 131 gross from your business. The 31 difference is what's going to go to dividend tax at various rates. Now, if your target is different, maybe you want to take home 80k or 150k, pause here and plug your number into the calculator, and it will show you exactly what gross income you're going to need. Once you've got that number, let's move to step 2 and work out what your business P&L needs to look like to support it. So now you need to extract 131,000 gross to take home 100,000. But you can't just pull 131,000 out of the business. That money has to come from your post-tax profit. Plus, you need to be keeping some profit back in the business. So let's walk through this. First, let's talk about retention. For a number of reasons, we don't want to be pulling every penny of profit out of the business. You need to keep some back as a cash flow buffer and for reinvestment in growth. Most financial experts recommend retaining around 20% of your post-tax profit. Some businesses need a bit more, some need a bit less, but 20% is a reasonable benchmark. So if you're taking out 131,000, that's going to be 80% of your post-tax profit, which means your total post-tax profit needs to be about 164,000. The other 33,000 stays in the business as retained earnings. Next, we need to work backwards through corporation tax. If you need 164,000 profit after corporation tax, how much do you need before tax? Corporation tax in the UK works in bands. As I'm recording this, it's 19% on the first 50,000 and then marginal rates up to 25% over 250,000. The calculator again handles all of these bands for you. For our example, to have 164,000 available after corporation tax, you need about 218,000 profit before tax. That's roughly 54,000 going to HMRC in corporation tax. So we need about 218,000 profit before tax to support our 130,000 extraction. Now, where does that profit come from? So as we said at the start of this video, profit comes from revenue minus costs, which means we need to figure out what revenue you need based on what your costs look like. Let's break costs down into two categories. First, your people costs. For a service business with a small team, people costs typically run anywhere from about 40% to 60% of your revenue, depending on your model and how extracted you are from delivery. Let's use 50% as our example. You can adjust this in the calculator based on your business. Second, we have other operating costs, things like software, tools, office space, insurance, accountant fees, marketing spend. All of these vary massively by business, but let's say 50,000 per year for this example. So here's what the maths looks like. If your revenue was 536,000, your people costs at 50% would be 268,000. Your other operating costs are that 50,000. So that means total costs of 318,000, leaving a profit before tax of 218,000. That's the number we need, which means to pay yourself 100,000 take home with all of these cost assumptions, your business needs to be doing roughly 536,000 in revenue per year. That's about 45,000 per month. So let me put that in perspective for you. To take home 100,000 personally after all the personal taxes, after corporation tax, while keeping 20% retained in the business, you're going to need to be doing 45,000 months consistently. Not 25k months, not 30k months, 45k months consistently. And that's assuming your people costs are 50% of revenue. If they're higher, say 60%, you'd need even more revenue to hit the same profit. This is the structural reality most founders never get true clarity on. They're doing 300,000 revenue a year and are frustrated they can't pay themselves six figures. But let's run those numbers. So 300k in revenue minus 50% people costs at 150,000 minus 50k other costs leaves you with 100k profit before tax. After corporation tax of about 22,500, you're at 77.5 profit after tax. We take out 20% for retention, 15,500, and you've then got about 62,000 available to extract. After personal tax on that extraction, you are taking home roughly 46,000. Do you see the problem? The structure just doesn't support a six-figure salary at that revenue level with those costs. So what are the main things killing your ability to pay yourself? There are three big ones, and I want you to check these in your own business. First, your people costs are too high as a percentage of your revenue. If you're at 60% or above, that's eating too much of your margin. You either need to get your people costs down or you need to increase pricing so revenue grows faster than people costs. Second, you're not charging enough. If your pricing doesn't account for the full cost of delivery plus a healthy margin, you are working yourself into a corner. Every project might feel profitable in isolation, but when you add it all up across the year, there's nothing left. Third, your overhead is creeping up without you noticing. 50k, 60k, 70k in software, tools, fixed costs. Every pound of overhead is a pound you're not paying yourself. You need to get ruthless about what's actually necessary versus what's nice to have. All of these three things compound. High people costs, underpricing, and overhead creep. Together they create a situation where you're doing significant revenue, but you have no profit left to actually pay yourself. And you won't fix it by buckling up and working harder. It's about restructuring how your business operates. So here's what I want you to take away from this. Paying yourself six figures isn't simply about hitting a revenue number. It's about understanding the full structure: personal taxes, corporation tax, retention, people costs, overhead, and building a business where the maths actually works. Right now, Download the calculator and plug in your own numbers. Your target take home, your people cost as a percentage of revenue, your other operating expenses. It'll give you a solid idea of what revenue and profit you need to hit your goal. And if that number feels miles away, that just means you know what to focus on now. Margin, not revenue. Cost structure, not just growth. Getting those three things right: people costs, pricing, overhead. If you want hands-on help fixing those three things and building a business that can support the salary you want, that's exactly what we do inside Calm. The link for that is in the description. And if you found this useful, watch this video next, where I walk you through how to find what you can leverage in your business to attract more revenue at a lower cost. Let's get you paid properly.